Did you know that Warren Buffett is raking in $5.26 billion every year just from dividends? It's not a secret. With companies like Coca-Cola, American Express, and Costco paying him millions in regular payouts, he has mastered the art of making his money work for him. But these aren't just random picks, they're dividend stocks, companies that consistently share their profits with investors. Now, assume adding that kind of steady income stream to your own portfolio. Wouldn't that be great? But how exactly does he do it? Well, Warren Buffett doesn't just pick stocks at random. His approach revolves around a steady strategy. So let's first analyze the basics before anything else to get a grasp of what you're getting into. Dividend stocks might not have the flashy headlines of the latest tech craze, but they play a quiet, powerful role in building wealth. So, what exactly are they? Simply put, a dividend stock is a company that regularly shares a portion of its profits with its shareholders, like rewarding loyal investors with a slice of the pie. These companies aren't just profitable, they're also committed to sharing their success long term. And while chasing the next big thing on Wall Street might sound exciting, dividends can actually make up a large part of an investor's overall returns over time. Now, how do they work? Well, it's pretty straightforward. If you own shares of a company through a brokerage account or maybe a retirement plan like an IRA, you're in line to receive dividends. When the company decides to pay out, the cash gets automatically deposited into your account. No extra steps needed. Companies usually pay dividends as a way of sharing profits with shareholders or when they feel like there's not much else to invest in. It's their way of saying, "Hey, thanks for sticking with us." And here's where Warren Buffett comes in. He's not just any investor. He's considered one of the greatest ever, with a fortune of nearly $145 billion as of 2024. And if you take a peek at his Berkshire Hathaway portfolio, you'll see a trend: a whole lot of dividend stocks. Buffett knows that while it might not be the most thrilling strategy, those steady dividends can add up to serious gains over time. It's one of his secret weapons. These dividends offer more than just passive income, they build wealth over time. And the advantages of these stocks might surprise you. When it comes to investing, dividend stocks are like the dependable friend who's always there when you need them. They may not have the wild swings of growth stocks, but they offer something priceless: stability. Interestingly, dividends aren't just a safety net, they're a smart source of yield, especially during times when bonds are barely paying anything, like what we saw before 2022. Even when interest rates shot up in 2022 and 2023 to tackle inflation, dividend-paying companies still held on to massive cash reserves, offering a great source of passive income. They are also less risky and more reliable. Even when the market takes a dive or some global event shakes things up, dividend-paying companies tend to hold their value better than more volatile growth stocks. This makes them a smart choice for investors looking to protect their capital. Add these stocks to your portfolio and you've got a diversified, lower-risk setup that helps you ride out market turbulence with confidence. Then there's the beauty of reinvesting dividends. When you receive dividend payments, you can either cash them out or reinvest them in the same stock. By choosing the latter, you're using those payouts to generate even more returns over time, thanks to the power of compounding. It's like a snowball effect, with your returns building momentum as you go. And let's not forget about market volatility. Dividend stocks are like a calm harbor in a storm. These companies are often large, stable, and less prone to wild price swings. With a simple buy and hold strategy, you can enjoy the peace of mind that comes from not having to constantly monitor the market's every move. As Warren Buffett wisely put it, don't watch the market too closely. If you're buying and selling based on daily price movements, you're not going to get good results. In other words, dividend stocks allow you to invest without the stress. Of course, as great as dividends are, no investment comes without risks. So, while dividends are reliable, they also come with potential pitfalls that investors need to keep in mind. Sure, they're often seen as the safe haven for income-seeking investors, especially when the economy gets shaky. But focusing only on those regular dividend checks can leave you blind to some pretty big risks. One of the biggest traps: the illusion of safety in high yields. A stock offering a sky-high dividend yield might seem like a golden opportunity, but it can also be a warning sign. Warren Buffett said it best: "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Don't get too dazzled by big yields without taking a close look at the company's financial health. Sometimes companies with high yields are the ones in trouble, with falling stock prices or shaky dividend policies. Remember the 2008-2009 financial crisis? Even major banks, which had been paying dividends for decades, were forced to cut or eliminate their payouts altogether. It's a hard lesson. Dividends aren't guaranteed. They're vulnerable to both the economy and the company's own issues. Buffett's advice? Always check the company's fundamentals before you jump in. Then there's the dreaded dividend trap, which is especially risky for new investors. You see a stock with a super high yield and think, "This is it, easy money." But here's the thing: those high yields are often caused by the stock's price falling, which can be a sign of trouble ahead. In the worst cases, these companies could be on the verge of cutting their dividends. But even with these risks, choosing the right dividend stocks can make all the difference. Warren Buffett has earned his legendary status in the investing world for good reason. He has a knack for picking the right stocks and sticking to some time-tested principles. Today, he's worth an estimated $140 billion, and it's no accident. By carefully choosing companies that deliver steady returns, Buffett has created a legacy of success that many investors admire. So, how can you find dividend stocks the Warren Buffett way? Let's break it down. First off, how has the company performed over time? Buffett believes in looking at companies with a track record of delivering consistent returns on equity for many years, not just a quick streak of success. The longer, the better. He recommends looking at least 5 to 10 years of a company's ROE to get a solid idea of its historical performance. So, when you're eyeing a stock, don't get swept away by recent gains. Focus on its long-term stability. Next, how much debt is the company carrying? Debt can be a double-edged sword, especially if a company's growth is fueled by borrowing. Buffett is cautious about companies that are heavily leveraged and prefers to see growth coming from shareholder equity (SE) instead. A company with a heavy balance sheet where earnings growth isn't tied to debt is what he's after. In simple terms, he's looking for businesses that generate enough cash to cover their liabilities without relying on loans to stay afloat. Buffett also pays close attention to profit margins. He wants companies with solid margins that are improving over time, not just temporarily. It's not enough for a business to have a good year here and there. He's after steady, reliable growth. Companies that are good at managing their costs and growing profit margins year over year catch his eye. As Buffett puts it, if a business does well, the stock eventually follows. Finally, how much of a discount are the shares trading at? This is a core principle of value investing. The goal is to find companies with strong fundamentals that are trading below their intrinsic value, and the bigger the discount, the more room there is for profit. While there isn't a one-size-fits-all formula for figuring out intrinsic value, you can look at things like the company's management, future earnings potential, and overall financial health. Buffett's strategy is all about uncovering these hidden gems, great companies that are temporarily undervalued by the market. Undeniably, dividend stocks may not always make the headlines, but they've quietly helped build some of the biggest fortunes in history, including Warren Buffett's. So, are you ready to start investing in stocks that pay you back? Let me know in the comments what dividend stock you're thinking of adding to your portfolio. In the meantime, you can leave a like, subscribe, and turn on the notification bell for more amazing videos like this one.